The choice between cash accounting and accrual accounting isn't just about crunching numbers. It's a game changer for strategy, timing, and perspective. The real question when evaluating these options is, do you focus on where you stand today or where you'll be in the future? But both perspectives are crucial, but for very different reasons. And if you're not clear on when to use each, you could be making costly mistakes. Sure, GAAP, GAAP, mandates accrual accounting. But here's the twist. Cash accounting plays a pivotal role in running a day-to-day operations, even in a GAAP-compliant world. Curious? Stick around as we break down these approaches, share real-life examples, and show exactly when each method becomes indispensable. What's the difference between cash and accrual accounting? The difference between cash and accrual basis accounting comes down to timing. When do you record revenues and when do you record expenses? If you do it when you pay an invoice or receive money in, it's cash basis accounting. If you do it when you receive an invoice or create an invoice, it's accrual basis accounting. And if you work in either accounts payable or accounts receivable, you will need to understand accruals. Accrual accounting is a far more powerful tool for managing a business. But, and this is a big but, cash accounting comes into play when managing the day-to-day operation. What is cash basis accounting? Businesses that use cash basis accounting recognize income and expenses only when it actually changes hands, when the money actually changes hands. They don't count sent invoices as income, and they don't count bills as expenses until they've actually gone forward and paid those bills, or as you know in the business world, we call them invoices. Despite the name, cash basis accounting has nothing to do with the form of payment you receive. When we talk about receiving payment, you can be paid electronically, and it still is cash accounting. The cash method is most commonly used by smaller businesses and also businesses with no inventory. But in general, if you're working for a company of even a medium size, you're going to be using accrual accounting, but that does not mean you don't have to understand and occasionally use cash accounting. What are the benefits of cash accounting? First of all, it's simple, okay? And that's always a big plus, at least in my book. And it shows exactly how much money you have on hand. It's also critical in periods where organizations might have really tight cash flow or in an off season for a seasonal business that does not have adequate cash cushion. What are the downsides of cash accounting? To be honest, it's not really accurate for the long term. It could show you as profitable just because you haven't paid your bills yet. Many will have worked in organizations that window dress financial statements at the end of the fiscal year by either paying every single invoice on hand or not paying invoices that should be paid the last few weeks or longer of that fiscal period. What is accrual basis accounting? Businesses that use accrual accounting recognize income as soon as they create that invoice for a customer. And they also recognize that expense, if you will, when an invoice is received. It's recognized as an expense even though payment won't be made for some period of days, usually 30 days or longer. What are the benefits of accrual accounting? You actually have a more accurate picture of the business performance and your finances, and you can make financial decisions, especially long-term financial decisions, with far more confidence. What are the downsides? It's a lot more work. And right off the bat, that might cause some of you to say, well, the hell with it. But no, you can't do that, okay? Because you have to batch invoices on both sides of the equation, both when you create them to send out to some of your customers and when you receive them from some of your suppliers, not just your bank account. Some organizations will also estimate a percentage for bad debt, i.e., they assume some small percentage, or at least I hope it's a small percentage, of those invoices they send out will not be paid. And they will make this estimation based on historical data. Now, before we get to our real life examples that I think will really bring these concepts home, I want to have one last word about cash accounting in the real world, or the real business world, if you will. If your organization runs some sort of a cash calendar, this is a form of cash accounting. Although this is typically done in the treasurer's department, not always, but typically. This is typically done to ensure that all funds are invested for the short term, or if you have excess funds, even for a day or two, they're used to pay down lines of credit. For even if that pay down is just for a day or two, every last cent not paid in interest or earned on a short-term investment is money that goes straight to the bottom line. Whether you realize it or not, most of us do a little cash and accrual accounting on our own personal finances. Let me share some simple examples of that. These examples will help cement the differences between the two types of accounting. If you're finding this content valuable, please don't keep it to yourself. Hit the like button. It's a simple way to let me and YouTube know that we're on the right track. Your support, believe it or not, makes a huge difference in our success. Real life example number one. Okay, we're talking now about personal, but you'll see the implications for the business world. Let's say your rent or your mortgage payment is due on the first of the month, and it's $1,000 in this simple example. And let's say the rent the rent is due December 1. We're in November now. And in my hypothetical example, credit cards don't exist, or the person that we're talking about doesn't have one. Okay? So now we're on the 28th of the prior month. We're on November 28th, and you get paid, and you pay a few bills. And when you're finished paying those few bills, the balance in your checking account is $1,500. Now, you want to go out with some friends for dinner tonight, and you're going to pay cash because you're all going to, put your piece into the pot. How much money do you have to spend? Not that you're going to spend it all, but how much in a theoretical world do you have? If you were using cash accounting, you might be tempted to splurge and treat all your friends to a fine meal, and you'd say you have $1,500 because that was the balance in your checking account. But common sense and or accrual accounting would tell you that's a really poor financial idea, no matter how much your friends might like it. Why? Because you're going to need that $1,000 to make that rent or mortgage payment in the next few days, and you're probably going to need another $100 to $200 for various expenses like gas and food, etc., to tide you over until you get your next paycheck. So in reality, the best case scenario in a really simple example would say that you have $300 to spend for dinner. The $1,500 in the bank, less the $1,000 rent payment, and less $200 that you're going to put aside for various living expenses for the next few weeks. And if you're cautious, probably less because you want to have some cushion left for emergencies. Okay, so you have $1,500 less your $1,000 less your $200. Okay, moving right along. Remember, no credit cards. Let's say you are expecting a bonus, and after taxes, that bonus will be in the neighborhood of $50,000. I know, from my lips to God's ears, but this is our little example. And the funds will be in your account on December 15th. Knowing that this big bonus is coming, you go out looking for a car, and you go out, it's December 5th. Now let's take a look at your finances. You've made that mortgage payment we discussed earlier. You spent $100 on that dinner on November 28th that we talked about, and you've just gone grocery shopping and filled up your tank with gas. So that $200 you had estimated for expenses is all gone. What you have now is $200 left sitting in your account, your bank account. The $1,500 less the $1,000 less the $200 for gas and groceries, and the $100 for that nice dinner with your friend. Okay, you find your dream car for $35,000. Good news, you can afford it because you know the $50,000 is coming. That's accrual accounting. But for a cash basis, right now, all you have in your bank account is $200. So cash basis, you have $200. Accrual basis, you have $50,200. Can you buy it? Yes, but only if you can pay for it after December 15th. Accrual accounting tells us we have the funds, or we will have the funds in the near future. Cash accounting brings us back to reality and makes it clear what we can spend today, although if the car dealer is willing to wait for payment till December 15th, then you can go pick up your car as soon as you get your loan. As you can see, both play important roles in managing finances, whether they are your personal finances or for those of the organization that you work. Cash versus accrual accounting isn't the only basic concept that those who work in accounting, finance, or accounts payable need to understand. That's why we put together a quick masterclass of other basic accounting concepts that you can watch right now using the link that has appeared on your YouTube screen and is in the description. Good luck.